Every store has that one rack at the back where the good stuff and the junk end up side by side at the same discount. The market has one too. It's called the 52-week low list, and there are 5 different stocks sitting on it right now, every one of them paying more income than it did a year ago. The whole job is working out which is which. In this video, I'm putting $10,000 into each of the 5. Each one of them ended up on that rack for a completely different reason, and I've ranked all 5 by how much they'd actually add to that 10 grand. At the end, I'll show you the one that finishes first, a 52-week low stock that's projected to turn $10,000 into a $1.6 million portfolio paying over $5,000 a month in dividend income. But remember, a number like that is only worth as much as the rules behind it. $10,000 into each one. Every dividend gets reinvested straight back into the same stock. 3 numbers drive all of it: what the stock pays you today, how fast it's been growing that payment, and how fast the share price itself has been climbing. Those come from each company's own history, and on 2 of them I dialed the dividend growth down because what they'd been doing looked a little too good to keep doing. And look, these are projections. Nobody knows what a stock does over 30 years. What the math shows you is where each one ends up if it keeps behaving the way it's been behaving. I'm going in order, good to best, which means the first one up is the one that added the least. 5th place, and it's the smallest ending number on this whole list. But keep half an eye on the income column because Hershey does something down there that none of the other 4 managed to do. So why is a company that sells chocolate to basically everyone sitting near a 52-week low? Cocoa. The price of that one ingredient this entire company is built on went to a record high. Margins got flattened and the stock came down with them. Here's what makes that interesting. Hershey didn't just wait it out. They pushed prices up hard, and it worked. First quarter sales grew 10.6% and adjusted earnings per share came in at $2.35, up 12.4%. And Hershey's own guidance for the full year calls for adjusted earnings growth of 30 to 35%. That's the company telling you the worst is behind them. The honest catch is volume. Hershey got there on price, and people bought less chocolate. Volume fell about 2 points on what they call elasticity, which is the polite word for shoppers walking away. If that price power fades before the shoppers come back, well, then the recovery stalls. Now, the 3 numbers. Hershey pays a 3.32% dividend yield today. It's grown that dividend at 9.24% a year over the last decade, and the share price has averaged 4.71% a year. That last figure is the smallest on this list by a mile, and it's exactly why Hershey finishes where it does. Here's what the projections show based on these numbers. After 1 year, $10,803. Slow start. After 10 years, $23,230. So the money's a bit more than doubled. 20 years in, $66,376, and by year 30, Hershey lands at $259,620. Now look at the income. That account is projected to pay $26,691 in dividends in year 30. That's $2,224 a month, rent money in most of the country. Total value added is $249,620. And here's the part worth sitting with. Only $85,224 of that came from the share price going up. The other $164,396 came from dividends being reinvested. 2/3 of everything Hershey made had nothing to do with the stock price. So, Hershey got marked down because of a crop nobody controls. The next one got marked down by a decision made in Washington, and its revenue actually shrank because of it. 4th place, and I'll be straight with you, on paper this looks like the weakest pick in the video. It finishes barely $18,000 ahead of last place, and the monthly income at the end is the lowest number I'm going to show you today. There's a reason it's still on the list though. Booz Allen does consulting and technology work for the U.S. government, cyber AI defense systems. Then federal contracts got cut, revenue fell, and the stock dropped about 39% from its high. So the market decided this company was finished. Here's what actually happened. Revenue fell 6.4% for the year, from $11.98 billion down to $11.22 billion, and the free cash flow went up from $911 million to $951 million. The top line shrank, and the company still squeezed more cash out of the business than the year before. That's the whole argument for owning it. And they've got $38 billion of work already signed and waiting. Against $11 billion a year in revenue, that's more than 3 years of business locked in before anybody picks up a phone. The dividend costs about a quarter of the cash coming in, which makes it the safest payout of the 5. The trade-off is real, though. Management is guiding earnings down next year, not up. $6 to $6.35 a share against the $6.51 they just did. Booz Allen's 3 inputs are a 3.38% starting yield, 8.63% average share price appreciation, and a 10-year dividend growth rate of 15.07%, which I cut all the way down to 8% because the last 3 years have run closer to 8 than 15, and I'd rather be roughly right than optimistic. Based on these metrics, $10,000 in this stock after the first year is projected to be around $11,201. By year 10, $30,826, 20 years in, $93,327, and by year 30, Booz Allen lands at $277,814, value added of $267,814. But the income barely moves. Year 30 dividends come to $7,015. That's $585 a month on a portfolio worth over $250,000. And you can see why in the split. $199,551 of the gain came from the share price. Only $68,263 came from the dividends. So obviously, this is a stock that makes you money by going up. Okay, we're 2 stocks in, about halfway through this. Biggest number on the board so far is $277,814. Remember now, at the end, I'll show you the stock sitting at number 1, the one that finishes with the biggest portfolio value at $1.6 million and pays the biggest dividend at over $5,000 a month. Third place is where the gap finally opens up. This one nearly doubles what the last 2 managed, and it pays the second biggest income number in the video. You've probably never heard of it. Watsco is the biggest air conditioning and heating distributor in North America. Not a manufacturer, a distributor. When your AC dies in the middle of August, that replacement isn't a decision you sit on, it happens that week. So why is it near a 52-week low? Because last year was too good. Watsco pushed through price increases that captured a wave of inflation and tariffs, and it inflated their margins by about 130 basis points. That was never repeatable, and they said so themselves. This year's numbers look average next to a year that was a one-off. That said, revenue still grew. Here's the number that matters. Watsco has $464 million in cash and no debt. Not low debt, none. In a video about beaten down stocks, that's the one where the balance sheet mathematically cannot be the thing that kills you. The 3 numbers on Watsco come out at a 4.27% yield, 8.11% average share price appreciation, and a 10-year dividend growth rate of 14.51%. And I trimmed that one down to 10% since that's roughly what they've actually been doing recently. As for the projections, $10,000 reaches about $11,238 after year 1. By year 10, $33,237. 20 years in, $120,219. And by year 30, Watsco lands at $481,076. Value added of $471,076. Year 30 dividends come to $30,622, which is $2,552 a month. Basically a salary, or part of a salary you don't go to work for. And this one's the most even split in the whole video. $260,576 from the share price, $210,500 from reinvested dividends. Almost half and half. Second place. And this one wins the position for a reason that has almost nothing to do with its dividend. Oracle is down more than 60% from its high, which is the steepest drop in this video by a long way. And the business didn't shrink. Oracle is spending enormous amounts of money building AI data centers, and the market stopped believing the payoff arrives soon enough. Their free cash flow last year was negative $23.7 billion. Against that, they're sitting on $638 billion of work customers have already signed contracts for. That's close to 10 years of revenue booked. So, this is a company spending itself into a hole today against a pile of contracts that pays out later. That's the bet. If the money shows up on time, you win. If it's late, well, the credit rating is already one notch above junk, and it'll get even more uncomfortable fast. Oracle's numbers are lopsided in a way none of the others are. A 1.54% yield, which is almost nothing, alongside 12.79% dividend growth and 12.3% share price appreciation. And this is the bit I actually want you to take away from this video. Nobody buys Oracle for income, but a dividend growing at nearly 13% a year roughly doubles what you're earning on your original money every 6 years or so. Wait long enough and that 1.5% turns into something that doesn't look like 1.5% anymore. It's a completely different strategy than, say, Watsco, aimed at a completely different person with a completely different amount of patience. And here's what the projections show. $10,000 in Oracle gets you $11,384 after the first year, $36,666 by year 10, and $135,372 by year 20. And then the last 10 years roughly quadruples it, all the way to $503,445. Of that, $432,926 comes from the share price, and only $60,519 comes from dividends. Nearly 88 cents of every dollar is the stock going up. Now the income, $7,832 in year 30, which is $653 a month. Oracle beat Watsco by about $22,000, but Watsco pays about 4 times the monthly income. And now, finally, taking the top spot at number 1, Nexstar. Nexstar owns local TV stations. Not the shows, the actual stations. In fact, they own more of them than anybody else in America. And most of the money doesn't come from advertising, it comes from contracted fees the cable companies pay to carry those channels. Now, pull up their payout ratio, and it reads 160%. Well, that should end the conversation, right? A company handing shareholders more than it earns is a company that stops handing it over eventually. Except, that's the accounting number. The cash number, same company, same year, is 32%. Here's the gap. Nexstar bought another broadcaster last year, and buying a company creates enormous paper charges that crush reported earnings without a single dollar leaving the building. The reported profit looks tiny. The cash coming in doesn't move. The market reads the first number, but the dividend gets paid out of the second one. and it's covered about 3 times over. That acquisition is also the risk. Nexstar borrowed heavily to do it. The deal was worth $6.2 billion, and it took their debt load to roughly 4 times earnings. They're now paying that down with the extra cash. Every dollar they repay moves value from the lenders over to the shareholders. And they've run this exact playbook before. In 2019, Nexstar bought Tribune Media, borrowed for it, and paid it down. The stock has roughly doubled since. Nexstar has a 3.9% yield, 14.18% average share price appreciation, and a 10-year dividend growth rate of 24.08%, which I knocked all the way down to 15%, because a company can't grow a dividend at 24% a year forever. And like I've done throughout the video, I'd prefer to under-promise here. Even at 15%, this is what happens. $10,000 in Nexstar is $11,808 after the first year. By year 10, it's $53,354. 20 years in, you're looking at $293,069. Finally, year 30, $1,661,254. That's more than the other 4 on this list added together. Not more than any one of them, more than all 4 of them combined. Total value added, $1,651,254. Of that, $1,237,391 is share price growth, and $413,863 is reinvested dividends. And the income? Year 30 dividends come to $68,923. That's $5,744 a month, about $188 a day, every day of the year. Now the part I'm not gonna soften. Nexstar earns about 2.5 times its interest bill. In comparison, Watsco earns 820 times. Nexstar stopped buying back stock completely so they can pay down debt, and local TV runs on a 2-year political advertising cycle. In other words, election years are really good for Nexstar, but the years in between hurt. The company they just bought saw profit fall by more than 1/3 in the last off year. So, Nexstar takes the number 1 spot, biggest ending number and highest monthly income by a distance, which makes the ranking look settled, right? But it isn't. Rank them by how big the account gets, and it goes Nexstar, Oracle, Watsco, Booz Allen, Hershey. Now rank them by how much they pay you every month, and it goes Nexstar, Watsco, Hershey, Oracle, Booz Allen. Nexstar wins both ways, so that one's settled. Everything underneath it moves. Look at Oracle. Second on one list, 4th on the other. And Hershey came dead last on the first one, but it's at number 3 here. They basically swap places. Same 5 stocks, same $10,000. 2 completely different answers. Every number in this video needed 30 years to work. But what if you don't have 30 years? I built the fastest route to $5,000 a month I could find while keeping risk manageable. That video is on screen right now.